Good morning everyone. Today we are going to learn about types of ratio analysis, one of the most important topic in management accounting. Ratio analysis is a technique used to evaluate a company's financial performance by comparing two related financial figures. It helps to the managers, investors, creditors and other stakeholders to understand whether a business is financially healthy or strong. In the financial statement alone provide a large amount of numerical informations. So however that ratio analysis converted these figures into a meaningful relationship that are easy to interpret. It assists in measuring liquidity, profitability, solvency, efficiency and market performance. There are 5 major types of analysis, ratio analysis. First one is liquidity ratio, second one is solvency ratio, and third one is profitability ratio, fourth one is activity or efficiency ratio, and the last market value ratios. First, the liquidity ratios. It measures the ability of a business to meet its short-term financial obligations. These obligations generally becomes due within 1 year period. A company with good liquidity can pay suppliers, employees, taxes and other current liabilities without any financial difficulties. The important liquidity ratio is current ratio, quick ratio, cash ratio. And next is solvency ratio. This is the second category of ratio. Liquidity ratio and solvency ratio to meet the long-term financial obligations. These ratios helps determine whether the business has sufficient capitals and earnings to repay the long-term loan and interest. The categories of solvency ratio is debt equity ratio, debt ratio, proprietary ratio, interest coverage ratios. And the next ratio is profitability ratio. It is evaluated the company's earning capacities and overall financial performance. Every business aims to maximize the profit while utilizing the resources efficiently. The major profitability ratios are gross profit ratio, net profit ratio, operating ratio, operating profit ratio, return on asset ratio, return on equity and return on capital employed. And the next ratio is activity or efficiency ratio. It is measured how efficiently a company utilizes its assets and resources. Efficient utilizations reduce the operating cost and increasing the profitability. The major activity ratios are inventory turnover ratio, debtors turnover ratio, creditors turnover ratio, fixed asset turnover ratio and total asset turnover ratio. The last ratio is market value ratios. These ratios are commonly useful for the investors and shareholders because they measures the market performance of the company shares. The market value of ratios are earnings per share ratio, price earning ratio, dividend yield ratio and book value per share. So the ratio analysis, it is essential for the financial analysis tool that convert the accounting data into meaningful informations. Each type of ratio serves a unique purpose and help the different stakeholders make informed decisions. Managers use these ratios for planning and control, and investors evaluate the returns of the values, and the creditors access the repayment schedules, and the shareholders measure the company performance. Through understanding a ratio analysis enables the better financial management and contributions to the long-term success of the organization. Thank you.